Last time I spoke with my guest on GoldCore TV this week, he said the stock markets were built on a house of cards and that at 68,000, he was rather bearish on Bitcoin. So when it comes to technical analysis, Gareth Soloway is a man to listen to. So stay tuned to this episode to see what his thoughts are and what the charts are suggesting for stock markets, bond markets, oil, Bitcoin, and of course, gold and silver. And listen to the end for very special charts on the gold miners. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts. Gareth Soloway, welcome back to GoldCore TV.
Thank you for having me back. It is so awesome to be back.
Now, we spoke last couple of months ago, and you said something that was very prescient at the beginning of that interview. You said that markets were currently built on a house of cards. Now, we've seen significant correction in a number of markets since then. We've seen increased volatility. Let's have a look at the charts and see where we're at the moment. Maybe we might start nice and broad and have a look at the stock markets. And I suppose the one that has been front and center over the last month has been the NASDAQ. What's your take on the NASDAQ?
It certainly has been, right? And we've seen the NASDAQ, it was just so strong when the Fed was at their easy money policy height where they were printing and they were expanding their balance sheet and interest rates were so low. And it only makes sense. I mean, I still remember vividly on TV where, so many analysts would come out and say, hey, don't fight the Fed. If they're printing money and they're pushing money into the system, you just got to go with that direction. And then again, what's interesting is we saw the Fed change course, right? Now the Fed is pulling back on the taper, or they're tapering, they're pulling back on the monetary influence and money printing, and they're talking about raising rates and lowering that balance sheet. So it only makes sense to think, well, we shouldn't fight the Fed the other way too, right? And sure enough, the markets have come in, and it only makes sense, right? I mean, you can only stimulate for so long and kind of prop up the patient, if you will, before you see the market starting to collapse down. And what's interesting here on the chart, right? So this was your March 2020 move, right? So the COVID collapse. And from that point on, this midline right here basically kept the NASDAQ in check, right? We went to the high, we pulled back to the lows, and we went up to the high again, back to the lows. And amazing how it kind of just continued until we got into 2022, right? And then you saw the breakdown. But look at where the NASDAQ stopped. Take the low of COVID right here, and it actually stopped on a dime right there as well. So short term, this line is support. I'm personally in the camp that I believe that markets eventually will break below this line, but in the very least, it is holding that longer term low end of the trend, matching up with the March 2020 low.
So you're staying out of the market on the NASDAQ, or you're not buying the dip and you think that there actually could be lower from here?
Well, the great thing about it is that there's always opportunity, right? So some of my favorite positions that I've been in recently, and I'm still in this one, is a company called C Limited, right? And look at the collapse. So the market always offers opportunity. What we saw over the past year is that a majority of the market was in a bear market. All right. While the tech stocks like Apple and Amazon and Facebook and Netflix and all these big names were all at their all-time highs, that was what was keeping up the NASDAQ. But the underbelly, and you can see this in August, this stock topped out at 370 and it just dropped and made a low below 120. So I mean, 370 to $120 in a matter of a couple months. That is opportunity to me. And you can see, I mean, from 120 back to over 160 is over a 33% move just off the lows. So I've been a buyer down here of this name. There's been other names that have bounced almost as much, like Cloudflare. NET is the symbol on this one. So there's always opportunities. Overall, I'm looking to short the NASDAQ again. I covered when we got to the low end of that channel I just showed on the NASDAQ 100. But if we get up a little bit, there's absolutely more downside to this market, and I will be looking to short more.
So a little bit broader than just the tech markets. What about the S&P? What's the chart showing you on that?
This is such a cool chart to kind of explain to average investors and any investor just what has happened, right? So if I zoom out on this chart, look at this. So this was your longer term trend of the S&P 500 going back to 2012, 2013, right? And it was,
Hmm.
still an uptrend. But then look at when the Fed came out with their steroidal, like massive inflow, right? I mean, and the great example of this is you have a healthy person, and then all of a sudden you inject a ton of steroids, and it's just like road rage to the upside, right? And so that's what happened with all this monetary influence. Well, now that the Fed is pulling it back, it only makes sense that we travel down to get back into this range, right? The longer term trend. Now, that's assuming we don't go into a recession. If we go into a recession, we could go obviously below this range. But if you get back to kind of that 2% growth on GDP longer term with not a lot of Federal Reserve influence, it makes sense that you'll come back inside of the longer term trend, right? But what that tells us is that you still have a long way to go to the downside over the next 6 or 12 months to get back in that range. So I do think that this is a shortable market right now, at least on the equity side of it. The main indexes, like I said, there are certain pockets where you can play for quick bounces, but I certainly wouldn't be long stocks and just expecting the market to continue to move up.
And that channel there, the upward channel there, looks like we're just back. We're back testing that.
Yes, which is a very common thing. So what you're referring to is a retrace to what I call the scene of the crime. So this
Mm.
trend line here has just been broken right there, and you can see it retracing and then or falling and then retracing to it, and that's usually the signal for the next dip. So I would say, if you and I talk again in a month or two, I would not be surprised if the S&P's somewhere close to the 400 or 420 level below this previous low pivot.
Now, none of this is happening at the moment in a vacuum. It's all being driven by Fed narrative and interest rates and expectations on hikes, whether they're actually going to hike or not, how many hikes they're going to do. What's the bond market? What are the charts in the bond market looking like at this moment in time?
Yeah, so I mean, you're definitely seeing, at least for the 10-year, right? And we can take a look at the 10-year here. Let me see. We'll look at TLT. We'll see what's up with that. Actually, TBT is a better one to give us the long side of that. So what you've seen is interest rates, again, grinding higher. This is the 20-year, so it gives us an idea. And you have in the short term taken out this high right here, which was that 1.75% level on the 10-year that we hit a while back in 2021 at those highs. So just be aware of that. It looks like it's a short-term breakout. I don't see yields going too much higher, though. I think you're going to get over 2%, maybe to 2.25%, but the Fed is going to put on the brakes, right? The Fed cannot let interest rates get kind of run away from the market and run away from themselves because number one, the debt load in the U.S. is meteoric, right? And if interest rates go too high, we just cannot afford to pay our debt. Number two, the higher interest rates go, the more it's going to slow housing, the more it's going to slow the overall economy. And the Fed has to be very careful that they don't push the economy over the cliff into a recession. So yes, they're talking a harsh game of raising rates and tapering and lowering their balance sheet, but at some point, they're going to watch very carefully and they're going to start to back off. What I think is going to happen is you'll see 1 or 2 rate hikes in 2022. And my guess is by the second half of 2022, the economy starts to slow significantly. And they're actually going to only get about 2 rate hikes in, maybe 3, but probably just 2 versus the market pricing in 4 right now.
And that ties in nicely with what you're talking about on the S&P chart as well. So we see these hikes, we see higher rates. We start to see a slowdown in the economy. We start to see a little bit of panic in the stock market. Probably brings that S&P back into that range as a result.
Yeah, that's exactly what I'm thinking. Exactly, and it makes a lot of sense. And really, it's a no-win situation because if interest rates go higher, it's going to hurt technology and hurt the markets, which is what we've been seeing recently, right? And if interest rates stall out and don't go higher, then it means the economy is starting to slow, which is then bad for stocks in terms of earnings growth. And it could also bring in. So it's hard for me to figure out a win scenario for the equity markets at this point in time, at least over the next 6 months or so, maybe 12 months, depending on how this all plays out.
And one of the key things that everybody's got their eye on at the moment, because it really hits the wallet very quickly, is the oil price in the energy sector. What's your take on the oil charts at the moment?
Yeah, this is a very interesting chart, folks. So just full and fair disclosure, I am short oil right now. I added yesterday, I believe it was, heavily to my oil short. And I'm going to show you on a technical basis why I did this, right? And remember, when I look at charts, charts aren't perfect. So there's always a chance that a chart can be wrong, but charts give you probabilities, right? So probabilities being greater than 50%, when I put my metrics together, I usually get about 80% success rate. And that's really the best you can hope for in the market. So always remember that. But one of the things that got me on the short side of oil heavily right up where we currently are, which was just a couple days ago, $93 a barrel on WTI, was a couple things. Number one, if I zoom out on this chart, we just hit a key level right here, right? So let me put this in right here. So a trend line, draw it right across, and you just hit. So you're hitting resistance right here going back to 2013. Think about that. Wow. 2013. Now that's just only half of the battle for oil here. If we zoom in on the chart, and this was really the kicker, that combined with what I'm going to show you now, I want you to take the high here from early 2021, connect it through this high, connected through this high, and look at what you get. And what this tells me is that every time we hit this line, you got to pull back. And what's even more interesting is that the pullback the first time was small, then bigger, then even bigger. And what it implies is you're going to get a bigger pullback here. And to find a target on this, what you want to do is just connect these lows, which go perfectly together, right? I mean, look at how the lows just align. And that gives you this target right here on oil. So for me, I'm looking at a market where the Federal Reserve wants to get inflation under control. Well, oil going up is not good. So you know they're going to attack oil. Then you have the midterm elections coming up. And generally going into big elections, whether Republicans are in charge or Democrats, there's always an attempt to bring oil in so the consumer is happier versus getting crushed at the gas pump. All right. And then when you add in the metrics here on oil, to me, it's a screaming sell on oil, even as bullish as many analysts are out there.
Well, okay. Very interesting. And everybody's going to be delighted to hear you say that, but also delighted if that comes true. Last time we were chatting, Bitcoin was making a new high, and you were quite bearish on it. Again, another fairly prescient call on that one. What's your take on Bitcoin now?
Yeah, so I mean, looking at the chart here, last time we talked in November, Bitcoin was close to that 69,000 high. So many people were screaming for 100,000. The charts were not telling me that. So number one, you had to see that we never confirmed. Even though you got above the breakout high, there was no confirmation of that move, which is a key metric I look for. Number two is you had
stop you there just so that everybody understands. What would you be looking for in terms of a confirmation?
Yeah, so confirmation is a signal I actually created, and it's amazingly accurate in telling you if there's a real breakout or if it's a fake out. So what we're going to do is we're going to take the April high and draw a straight line across, right? So it's perfectly straight right here. Now, what confirmation is it's confirming a breakout, meaning that it occurs after the initial close above the candle, above the trend line breakout line. So basically above 65,000. So what you can see here is you closed above this trend line once. The next day you pulled back below. To confirm, you needed a second close above that first high right here. Okay? So number one, it didn't occur. So what we do is now we look for the next time it gets above. The next time it gets above again here and even makes a higher high, the next day it doesn't close. The daily candle doesn't close above that high. It closes below again. Then you close back down and the rest is history. So basically what this was telling me is that there was either games being played by institutions to try to get maximum small investors buying, which does happen, right? They try to tease, even though they know they're going to push it one way. They want to get the most shorts to cover, and they want to get the most small investors long so that they can sell their positions. The other thing was this coincided with the Bitcoin ETF that tracks the futures debuting. My issue with that is that it created a ton of hype, which is never good. And number two is if you go to 2017, guess when the markets made, when Bitcoin made its high? When the futures on Bitcoin debuted. So the 2017 high was the Bitcoin futures debut. The 2021 high was the ETF for the Bitcoin futures debut, both creating insane hype. So we've seen a very nice pullback here in Bitcoin. I still have it ultimately going lower, but short term, you have a little bit of a breakout here. I want to just show you one last thing here on this chart is look at where Bitcoin just stopped. Right here, you have this trend line connecting through this low to this low and then through this high, and Bitcoin stopped on a dime right there and is now starting to pull back. So my short term, we just hit. I actually was long, and I'm still along a little bit of Bitcoin. I bought it down in this lower range here. I sold some yesterday, obviously popping above 44,000. But ultimately, if you ask me where Bitcoin is in 6 months, I think it's at 20,000 or sub 20,000.
We'll remind you of that in 6 months' time. Now, obviously, our audience is very interested in precious metals. So if we can pull up a chart on gold and then probably on silver as well. But also, I'd like to talk a little bit today about some of the gold miners as well, if you wouldn't mind.
Sure. So let's look at gold first, then we can touch on silver, then we'll look at the miners. So gold continues. I think even back in November, I basically we were at the same point, right? So the positive about gold is that it hasn't gotten smoked with the stock market nor with Bitcoin. So it's holding its own. And what tells me that's actually the likely outcome, and why I was bullish on it when we were talking about it, is because number one, you have a longer term move up here, and this is all sideways consolidation, which is actually bullish in a chart. When you see a chart digesting a big move, so this was a big move from 1150 to about 2075, it's all digesting in the upper 30% or so of that move. Now, shorter term, you're looking for a breakout outside of this wedge pattern, which I do think will come, which will send us back to 2075. But the other thing to keep in mind is that if you go back to the 1970s, the mid 70s to the mid 80s, and you look at what gold did, it's almost replicating exactly what it did then. And people might say, well, that's crazy because, why did it, when inflation's as high, why is gold going sideways? But let's take a look. So before we go to 1975-ish, just remember this. Big move up on gold, a pullback here, and then remember the next move that's coming when I show you the 70s chart. So what we'll do is we're going to go to the weekly because I think we'll get there a lot faster here. Otherwise, it could take us a really long time. But here we are right here, right? So check this out. And this is just the coolest thing ever, right? So here's your early 70s where you kind of started to make this big move up, right? So you had kind of this wave up, but then into 75. And by the way, inflation was very high in 1975. But what did gold do? It went sideways. Notice how it's staying in the upper range of this initial move, but it's pulling back just like what we're seeing now. And then from 77 all the way to 1980, so over the next 3 years, look at what happens in gold. So again, now this is pretty wild, right? I mean, $100 to $900. I have a hard time believing that's going to happen to gold at this point, especially with Bitcoin as an alternative. But is it possible to see gold in the next 3 years go to 3 or 4 or 5,000? Yeah, I mean, I think 100% move up in gold is very, very likely, and that would only be a fraction of what it did in the late 70s. So really, history has a way of repeating, or at least rhyming, and it's always good to look at past periods when you had the same things going on, like inflation and all these other things, because it really can tell you about the future in anything commodities related. So very cool stuff there.
Awesome. And then moving on then to silver.
Silver, absolutely. So silver's a little trickier for me. I'm much more of a hardcore gold bug versus silver. I think silver longer term is a no-brainer long just because of the continued inflation that I expect. And just to be clear, I don't expect inflation to be 8 or 9% for an extended period of time. I really do think it's going to come in a little bit as the supply chain issues fix. But do I think it's going back to 2%? No way. Not with the wage inflation that we've been seeing that'll be passed along to consumers for the next 5 years or more, based on what people are now demanding to go to work. So the issue that I have number one, silver has a bullish pattern, much like gold, bullish pattern. The only issue I have with silver is that I worry that if the economy starts to slow because the Federal Reserve is hiking rates, does that then put an issue where the demand for the industrial side of silver gets a little bit of a damper? And that could just bring silver down a little bit. So for instance, I'm really excited to accumulate if we ever get back to this 19-ish level. Huge support there. Now, it may not get there. With the inflation, what we're seeing, if it continues to be heavy inflation, at some point you're going to break out. It's just a matter of, does it dip to 19 first? All right. So yeah, very interesting stuff here. I ultimately, if you told me you have a horizon of 3 or 5 or 10 years on silver, buy it. Who cares about $3 or $4 to the downside if it's going to $50 or $75 an ounce? If you're more of a shorter term trader like I am, that's where you're a little bit more hesitant on the silver chart versus the gold chart. All right.
Got it.
And let's take a look at the GDX here. Love looking at the GDX. The GDX ultimately will likely follow gold. You can see it had this big move up here, and it's basically been consolidating. So I think that's what you're looking for. You're looking for a breakout above this trend line right here. And once it does, you should see some really good gains. The only issue with, a lot of people ask me, well, would you just invest in gold miners because they generally move up a lot more than gold if you think gold's going up? And I would caution against that, and this is why. So if you look back at periods of higher inflation, gold miners do very well early on when gold is ripping. But if inflation persists, their input costs actually rise significantly. So I would recommend a balanced approach to investing in the metals, on spot prices like metals themselves, and then also having some exposure to miners, but not going all in on miners. Because remember, if oil keeps going up, think about all that machinery that's being used. What about the metal prices of all this machinery? All that kind of stuff can skyrocket and make it very tough for profits in the gold miners.
Makes a lot of sense. Before we wrap up, can you just remind everybody how they can learn more about what it is that you offer?
Absolutely. So Twitter's awesome. So come follow me on Twitter. It's free. I post a lot of great charts on Twitter. I even posted one just recently on Facebook, as I think Facebook's getting ready to bounce. I'll just show you guys that one real quick. I hope you don't mind. But what you see here is this beautiful trend line from this pivot to this pivot in this area, and you're basically right into that level. So 220 or just below 220 should be a good short-term swing trade level on Facebook to get a bounce. But Twitter, is a great place to follow me. And then if you're interested in my actual live trades, I post those in at inthemoneystocks.com under my service verified investing alerts. So great information there. I cover commodities there. We trade GLD, GDX, all that fun stuff. Great place to go.
I'm going to stick a link to your site and also your Twitter handle in the show notes below this video and in the description. So anybody that wants to follow up with Gareth on any of these things, please click on those links and go to his site and learn more about what it is that he does. But for now, Gareth Soloway, thanks for joining us on GoldCore TV.
Thank you so much for having me. It's been a pleasure.
Thanks for watching. And if you enjoyed this video, and in particular the section on gold and silver, you're going to really enjoy these recent interviews that I did. One in particular with Rick Rule and another with Jim Rogers. Check those out next. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.